What's up, guys? Ron from Rohde Law, and today we have a really exciting speaker. It's Chad Griffiths. He is a commercial real estate industrial investor based up north in Canada. But we're going to talk about his first investment deal, how he got started, how he got the money, how he sourced the deal, everything. And then finally, we're going to learn about his long-term outlook and his goals as an industrial investor. So welcome back to the channel. This is going to be part two of Chad Griffiths, the industrial investor. Part two, check the link for part one, but this dive into the process for Chad to get his first deal, how he raised the money, and continue that journey as he grows his investment portfolio. So we're investors, we're here to make money. Real estate is our preferred option if it's the highest and best use of our time and our money. How did you find the first deal? One of the pieces of advice that I always give to my listeners is set your own goals. You have to know yourself first, but what were your goals as an investor before you bought that first deal?
Yeah, and I had owned some real estate prior to getting into the industrial space specifically, which is where I've got all my money now. But I had owned some single family houses. I owned a fourplex at one point. So I had experience in that space. When I got into industrial real estate and just quickly fell in love with it, I knew at that point that that's where I was going to have to pivot and pursue that, not just as a career where I wanted to make a living, but also as where I wanted to start investing. If you're going to spend all that time in an asset class and you get to know it and you get to know the ins and outs of it and what's an appealing investment, it only makes sense that you try to invest in something you know really well. So when I started in 2005, I was also had a young family that I was starting. So it took time just to buy a house and buy cars and get your kids into sports and just everything that comes with living. So I probably wasn't even in a position financially to have excess money probably until 2012. Great Recession was in there. So that 2009, 2010 certainly wasn't fun for anybody. So it was probably around 2012 where I started getting to a position where I could deploy my own cash. And then I was just very patient. And that's what I'd encourage anybody that's considering industrial real estate investing. The mindset to take is that don't rush into anything because there'll always be a deal. And there's deals that I've passed on, which I'm sure would have looked very attractive right now. And in hindsight, I wish I would have done them. But you can never look at things in hindsight. You can only make the best decision you can with the information you have available. And that's being patient. And if it takes 2 years to find something that checks all the boxes and you're comfortable with, especially for that first deal, you can take a little bit more risk once you have a little larger portfolio and one transaction might not impact you as much. For the first transaction, that was like all my investable capital was going into that property. So my partner and we found a small little warehouse condo. This is another misconception about the industry, is that it's all this large industrial, like the big 1,000,000 square foot Amazon facilities.
I hate that. I feel like that's if I could have one pet peeve of the industry, it's the problem with industrial is that it is the broadest commercial real estate sub asset class. And nothing else comes close. I think maybe retail is similar, but it doesn't come close because it doesn't have that manufacturing. It doesn't have all the specialty types. But it's such a broad range. And when people say industrial and they say warehouse, I want to buy a warehouse. Well, they say, what is that going to be? A 34-foot clear height, 600,000 square foot building that's leased by Amazon? They're like, yeah, great. Pony up $78 million to buy that building. And they're like, what? Why is it so expensive? I thought the rent is like $2 a foot or something. And so, yeah, there is a conception, and maybe we should be the ones that start changing this, only referring to the sub asset type, flex or manufacturing or outdoor storage or whatever your fancy is. But even distribution, right? There's still smaller distribution centers that don't have the Amazon, the FedEx, the Nike. When you want to go on this tangent, I hear you because it's so broad and people don't even know what they don't know.
And that's why I think industrial scares people, is because they think that they have an idea. And then once they start looking into it a little bit further, their minds are just opened. And anytime someone's mind gets open to that level, they tend to get a little scared, and rightfully so. It's a complex asset class. So it does take time to learn, but I couldn't agree with you more on that. It is so diverse, and industrial just gets grouped as this large industry when really there's a tremendous amount of difference between a manufacturing property and a distribution center. Even though to the layman it might not seem like it, once you start getting into it, and most importantly, if you're going to start putting your money into it, you really should be able to differentiate between the two.
Prologis, as the world's largest industrial real estate owner, they are very niche. They don't own heavy manufacturing sites. They don't own outdoor low coverage sites. Maybe they have land, speculative land for development, but they are so focused on their single sub asset type, one or two maybe. And it's incredible that they can be so big, not owning a huge chunk of what comprises industrial. So
yeah, 1.2 billion square feet with that acquisition they did of Duke Realty last year, largest real estate owner in the world. But you're right, they only own in specific markets. So
right.
they won't be in small tertiary markets or secondary markets. They are in major markets, and they buy anywhere from 200,000 to 2 million square foot distribution centers. And that is their model. They're like land constrained markets. So they love California. They love New York. They love some of these hot markets. They're big in Dallas too. It's a interesting firm, but that's what a lot of people think of, is they think of this company with these large distribution centers. That first unit that I ended up buying was an industrial condo. So similar type of style. Some people might call them strata units or condo units. Residential, it's very common where you have a apartment building, and then each individual unit has its own legal title and it shares some portion of the common area. That concept isn't unique to just residential. You could find that in office, retail, industrial is a common one. First one that we bought was a small industrial condo. We've since bought larger properties, but that first one was a 2,000 square foot industrial condo. And the company that was in there was a company that serviced kitchen equipment at restaurants. So they would go around, if a restaurant had their stove break or their grill break or some kitchen equipment breakdown, they'd go to the location, try and fix it on hand at the location. If they couldn't, they'd bring it back to the shop, the one that we bought. So when we bought it, it was filled floor to ceiling with just random kitchen garbage, like everything you could imagine, motors and like it's just
was
crazy.
It spare parts? Was it customer parts, or was it junk? Was
yeah,
it trash?
Both, all three, all three. Some probably useful parts, a lot of broken down stuff, and then garbage everywhere. But they were a great business. So we bought that when the owner had just put them in there, and he still wanted to sell. So we had a new 5-year lease with this company that was in there. This was in 2014, and at the time, we even asked him to do a vendor take-back mortgage. So he agreed to give us, at the time, I believe interest rates were probably in like that 4% is what we probably would have got an interest rate for. We gave him 5% on an interest rate. We had him do a 3-year open mortgage where we could pay it off at any time. And it was a little bit convoluted because he actually owned 2 units. We bought one of them. We had to split some electrical off. We had to split some HVAC off. It only had single phase electrical, so we had to upgrade that to 3-phase electrical. So there's a lot of things that we had to do. So just kind of using some round numbers, we ended up being into it for about $100,000. So both my partner and I put roughly 50 grand in each. He carried he carried the mortgage for us on the balance. He owned it free title, carried it for us. We ended up buying it out within a year, actually, because we bought another commercial unit. And this was us thinking that we were big shots at the time, because this is still kind of a crazy story on how we did it. We found another unit that we wanted to buy. We went to a traditional lender, and we had the lender do a blanket mortgage. So they actually gave us financing to buy the new unit, and then they gave us financing to take out the guy who was carrying a mortgage for us. So now we had this blanket mortgage, which we still like to tell people about because it's not common. You don't see a lot of blanket mortgages for new investors,
especially not for just two small units.
Two small units, yeah. And we had a large bank that actually financed us on it, and it was about the same. The next one that we bought, so the first one we bought for 400 grand, next one we bought for 450 grand. I think we put in another 50 each on that one. So now we had like a small real estate portfolio, call it 950 grand. Those are the only two, and that was an industrial condo as well. Those are the only two condos that we bought. Everything else we bought since then has been larger freestanding buildings. We have one building leased to a Fortune 1000 company. It's a manufacturing building, about a $3 million building, 15,000 feet on 4 acres roughly. Awesome building, single tenant that's in there. And then we have some multi-unit buildings as well. And then we just closed on one in December for 6.5 million and change, with a few tenants in there. A few large tenants in there as well. So it started off very small though, like a 400,000 square foot industrial condo leased to a kitchen equipment repair company. That was our entrance into the industry.
See, but what I really love about your first buy is that you still remember a lot of these details because you dove into understanding the tenant's business. Because in order for you to feel comfortable writing that check, you've got your 50,000 simoleons that you really cherish and you're going to hand it over to somebody else. You needed to understand what the tenant's business was. And again, I think that represents a shift from a lot of people coming from anything residential, even self-storage, mobile home park, all this stuff, where you're dealing with people. And the story behind each tenant, it doesn't really matter. It doesn't matter what they do, where they're from, how they pay the rent. You just know, well, it's rent. You got to pay it. They're people. That's it. Whereas on the industrial side, you really are underwriting the tenant to a large degree. And we can debate about this on another video. Are you buying the income stream? Are you paying for the value of the lease? Yes, to some degree, but you're also buying the underlying real estate if the tenant goes dark. But you strive as much as possible when you're paying for value according to the lease, understanding that tenant's business. And so was that something on your checklist that you downloaded online, or was that just kind of something natural that came to you, which was simple and logical that, hey, this is the guy who's paying the rent and generating value. I need to understand his business so that you 10 years later can say, yeah, I understand his business. I know what he does intimately.
If I could add 2 more points on that as well, and absolutely, I know every single business in our portfolio and what they do, but even beyond just your own comfort, knowing what the uses has other implications, insurance implications, because some insurance providers are very cynical on certain types of uses. If there's a higher risk of fire or property damage, they will. I've dealt with tenants in the past that have actually had a hard time getting insurance for just the reason of their business. A recent one actually was a company that handled a lot of chemicals, and there was just no insurance provider. We probably talked to dozens of insurance companies before we found one that would give them a policy, just because of the handling on it and all the different things that can go wrong. So insurance plays a big factor, and then also environmental plays a big factor. So it's without going too deep into this, I'm sure anybody tuning in this probably has some familiarity with industrial. And it's with commercial too. Is you need to have an environmental site assessment as a condition of your lending for the most part. It's a very general statement, but you'll likely need an environmental report. If there's any,
I'll interrupt. We call it a phase 1. So when you hear
yeah.
people talk about a clean phase 1, this is the environmental report they're talking about.
Yeah, and I mean, you could go to a phase 2, you could go to a phase 3 or a phase 4, and each step involves more time and more money and more stress. But ideally, you just want to have that phase 1 saying there's no indication that there's contamination. And if you're dealing with some uses out there are very, very hard on a building, and they can cause significant contamination. Dry cleaners are really bad. And you think about a dry cleaner being in a retail location, but a lot of them will have that as the storefront, and they'll actually ship off all the clothes to an industrial location where they'll actually do the laundering. And there's a byproduct or just a part of the process of dry cleaning called percyl ethylene, I think it's called, is the long one. If that's not handled properly and that gets into the soil or gets into the groundwater, it can wreak havoc, not just on the building, but that person could be liable for damages that it causes to neighboring properties. So if a dry cleaner is a tough one, where you just want to make sure that if you are going to accept a dry cleaner, that you know exactly how they're handling
Yeah.
their process. Welding might be a bad one. Chrome plating can be a really bad one.
Plating is any type of metal plating is very, very caustic. The remediation for that is, in the millions of dollars, which very quickly exceeds the dirt value. So yeah, we could probably do a whole episode about
We
remediation, because
yes.
there's all sorts of different chemicals that I've done some where they can just be watered down. So depending on what the report says, if it has a certain kind of ethyl or glycol base, I think somebody's an engineer, correct me. If it's glycol based, all you have to do is buy water and you can flush it and dilute it. It just goes into the groundwater, but you can remediate just by pumping water onto the site.
Mm-hmm.
Versus some of the other ones will be like petroleum products, right? That's also very common when you have car repair, auto repair, anything where there is oil, lubricants on site, motor oil, used motor oil, not really the coolant. The coolant is like a glycol, but transmission fluid, those sorts of things. Those can also be contaminants, and it can be rather costly, or it can be less costly, right? A few $100,000 versus 500,000 to remediate, where you maybe physically scoop the dirt out. So that's another way you can remediate, is you physically remove all of the contaminated dirt and truck it somewhere safe. But
It's a big process.
so it's scary, but my goal of this conversation is to show people you can become as knowledgeable as Chad and I. There is nothing that we know that is some secret, right? It is not some guarded secret, but you shouldn't be scared of something if you have the means to learn and educate yourself on the process. And so that's what this is. Yes. Do you need a phase one? Yes. All commercial lenders are going to need a phase one. I think I talked to one lender who said actually they don't require it for some loans below like 750,000. So if it's a signature loan where the officer can just give you a loan for even for a commercial property, you don't need a phase one. But anything bigger than that, they require a phase one. So you're going to need to know what this report is. I'll put some costs up here. It's about $2,000 in Dallas as of 2023. All right. Well, that wraps up part 2 of Chad Griffiths' investment journey. Stay tuned, and then we'll post part 3 coming up shortly.